Hi, this is Bo Yoder from 5minuteinvestor.com. Take a look at the Australian dollar versus the US dollar. Kind of an interesting patterns set up in a trade I've taken. Thought it'd be worth highlighting for your interest in education. We have a very sharp drop in the dollar versus the dollar. The market sold off radically over the course of several days, moving back down into an area of fairly strong chart support. As you can see here, it's an area of resistance. That resistance, once broken, became support when retested. And although the support has held, it's taken its sweet time getting ready for any real trend. We have a classic peak bottom which formed in the Australian dollar. I actually took that trade early on, getting a pretty decent entry and then moving back up towards the highs of the range. As it started to waffle, though, it looked to me like it might be ready for a move back to the lows, so I took profits on that trade and then re-entered just today as the market made a higher low and began to challenge the highs of what I call a low-level base. Now, this is a pattern that works very well in stocks. You tend to see a stock that's been downtrending for a long period of time, perhaps several years in some cases, and it finally begins to chip chop near its lows. Often the chip chop is very violent, a lot of highs, a lot of lows that are taken out, but then it kind of settles down. It begins to form this slight little coiling action, which really shows some deeper pocket accumulation. As that accumulation period comes to an end, the market will tend to make higher lows and higher highs within the range, eventually testing the highs of the range and breaking out to the upside. It's especially sweet when the market breaks above a resistance level that's a rounded number. In this case, 8,600 even was our round number in the Forex. So a very clean, low-level base pattern. As you can see, it broke out with some heat, based a little bit, and is now continuing to trend. In terms of an MPO, or minimum profit objective, this is a wonderful trade because there really isn't a lot of resistance overhead to worry about. Really, the only area of resistance that I see that catches my attention is 87.50, and then once you break through that level, you're looking up here at the 88.50 area. So there's several hundred pips of upside potential on this bottoming type action. This really shows a swing trade type trade looking for a 3 to 5 day hold, which is quite different from the intraday trades or the position trades. Again, the difference for me between positions, swings, and intraday trades are very much psychologically based. With a position trade, I'm trying to capture a move in a market that I believe will be trending. And so if a market's trending, I don't necessarily know where its tops or its bottoms are going to be, and so I'm on for the ride, and I'll be looking for the market to make some kind of a complex topping pattern in order to get me out. Contrast that with a swing trade, which is what we have here in the Aussie dollar, where I'm expecting the market to move from point A to point B for whatever reason, be it pattern-based, psychological, economic, or what have you. In this case, I think the Aussie is going to lift up out of this low-level base and tag this area of resistance. So that's a swing trade. I'm trying to capture the swing between point A and point B. A day trade, or a scalp, on the other hand, is just trying to capture a burst of order flow, a burst of liquidity. So a proper scalp trade in the Aussie would have been to buy the breakout and then sell into this spike here, not allowing the market to go against you at all, certainly not holding any wiggles, just trying to capture a spike move or a quick reversal. And that's almost more of a market-making strategy than a real trend trading or swing trading type strategy. I would say 90% of my trades in the Forex tend to be swing trades, as this market does tend to ping-pong between areas of support and resistance. I've done a few position trades, but I tend to do that more in stocks where the intraday and daily volatility is such that I know I'm probably going to get whipsawed out of positions and therefore need to be trading those stocks in deeper time frames. With the Forex, though, you're looking at $1 trillion a day market. This is a market that's very active and very deep, so it doesn't tend to whipsaw quite nearly as much. And so, therefore, these swing trades are a lot more effective as an overall core trading strategy. So there you have it, some analysis on the Aussie dollar. A nice little pattern there. If there's a pullback later on, you might be interested in grabbing it. Of course, this trade was given before it's set up to the subscribers to my Forex trading letter. So stop by the website at www.5minuteinvestor.com. Take a trial, see what you've been missing. As always, thanks for listening. My name's Bo Yoder. Good luck and good trading.